Hi everyone, this is Dimo Gonzalez of Heartwood Financial Services. Thank you for tuning in to another market update. It's for the third quarter 2019. Hope you enjoy it. So before I get too far into the presentation, I just want to give everybody some breaking news. TD Ameritrade, it all started with Schwab, followed up by TD Ameritrade and E-Trade so far, maybe more coming, have decided to waive commissions for stocks, ETFs, and options orders. And so this is pretty big news, basically zero commissions. And this has been the trend. They keep going down and down, and they're all trying to one-up each other and take market share from each other. So the ultimate winner on all this, I don't think it's going to be the brokerage companies. It's going to be us. So I'm very happy to report that. Now they're still going to be charging some fees on mutual funds and things like that. So not all is gone. But this is good news overall for any time we have to deal with stocks or the ETF that has the commission on it. So I just wanted to let you all know. Okay, so here are the asset class returns for the quarter and year to date. Starting off with the S&P 500 or large cap stocks. You can see that we're up about 20% through the end of September. October has been down a little bit, but this is still since the end of September. For the quarter, up 1.7%. Small cap hasn't done quite as well, though we've seen a little bit better performance here for the month of September, but up 13% or so for the year, and actually down a little bit for the quarter. When you look at real estate, again, that's still been leading, and it's still been doing very strong for the quarter, up almost 30%. For the year, up almost 8% for the quarter, so the strongest performer for the quarter. Developed market international, doing okay, up 13% for the year, down a little bit for the quarter. Same thing with emerging market. It's not doing quite as well as the developed markets, up about 7.8 for the year and down 3.73 for the quarter. A lot of this has to do with what's going on with currencies. The dollar has been very strong. And you also have the issue with the trade wars that have been hurting Asia and Europe especially. So if something changes there could be some pretty major changes in these indices as well. And in the bonds, up 7% plus for the year, up another 2% for the quarter, still performing very well. Interest rates have stayed low. They have been coming down. As growth in the globe slows down and goes down, the interest rates go down for these bonds. And as you remember from my last video, that when interest rates go down, the value of bonds go up. Thus, good performance. On the high yield, probably surprised a lot of people, up 13.5% for the year, up 2.3 for the quarter. It's been one of the strongest areas of the fixed income markets. Again, high yield is the riskier segment of the bond market. And commodities up 4.6, down 2.1 or so for the quarter. Includes gold, but it also includes oil and things that have been down. So overall, pretty good quarter. We were up overall for the quarter and still doing very, very well for the year. So I'm sure you've all have noticed that it's been a little bit more volatile the last quarter or so. And so there's been essentially 4 key drivers to this volatility. And so to sum it up, the Fed has been probably the main driver of this volatility. As of the beginning of the year, they made a U-turn, and they went from being very hawkish, meaning that they wanted to slow things down, raise interest rates, to being dovish, meaning they want to stimulate and be a little bit easier with the economy. So this has been a big change. They keep kind of fumbling around with their verbiage. Sometimes they say that they're going to just do a little bit and not do any more, and now it looks like they're going to do more. They're starting to acknowledge that the economy is definitely slowing down, especially globally. So they have become a lot more accommodative recently. But that has been one of the very key drivers to all the volatility. And of course, trade. This continues on. Hopefully there will be an end in sight, but I'm afraid it's not coming very soon. But hopefully there'll be at least be some clarity in October. In fact, next week, China's coming back to the U.S. to meet with the trade negotiators. So maybe we'll make some headway there. At the very least, maybe get some a truce, So that could help the economy. I don't think the market's really pricing in much good there right now. So anything positive there could be a nice boost. But for now, it's mostly a headwind. The geopolitics has been a little bit of a mess. In fact, that might be an understatement. You got everything from Brexit to Iran to North Korea to Hong Kong. So there's, and of course here in the U.S., let me not forget that, right? Impeachment hearings and everything else. So the geopolitics has definitely been a headwind. Some things are getting a little bit better there. Brexit, it's going to maybe come to a close here soon. We'll have to see. I might be a little optimistic there, but in October there's a deadline and something's going to have to happen. So hopefully there'll be some clarity on that. And Iran, it hasn't gotten worse. It seems like Saudi Arabia at least is, shooting off missiles back to Iran, and we haven't gotten into a war. So that's a good sign. Oil has been very stable, so I'm sure that has helped. And the last thing is really the data points. The globe does seem to be slowing down. We had some data points in Germany that weren't very good, showing signs of recession. And there are some signs here as well in the U.S., although not as bad, that I'll highlight in a minute, that have been showing some slowing down as well. So the math of the market, I've gone through this slide many times, so I won't bore you with all the details. But the bottom line with the math of the market right now is it seems like we're priced in fairly high, not too high. What I anticipate based on earnings, which has been downgraded just a little bit, but not very much, and the average PE ratio in the low interest rate environment that we're in right now, is that we could probably expect somewhere around 5+% for the next 12 months, which again is still better than bonds paying only 1.5%. So relatively speaking, not as bad. And so this might be a little bit lower than in the past, which again might signal an opportunity in other areas outside of the S&P 500. And I always like to look at the leading indicators. The leading indicators so far are still holding up pretty well. This chart here, the red again is the average of all the leading indicators. We're still in the top left quadrant, meaning we're still in a growing environment, but the speed of the growth is slowing down. And so we're still pretty far away from getting into recession territory. Usually we're in this rectangular area here, and based on the actual raw figures, we're still a pretty good percentage away, maybe 18 months or longer. So this is something that I'll continue to keep an eye on, but there has been some areas that have been flashing signs of warning that I'll highlight here in a minute. But this is something that again is still relatively holding up well. So earlier in the week there was quite a bit of volatility with the market. The market had a couple bad days. The main reason was the manufacturing sentiment. There's a number by a group called ISM, and they have a sentiment indicator by purchasing managers. It's called the PMI, Purchasing Managers Index. And this is a chart that shows the history of this sentiment indicator over the last 5 years. And you can see recently it's been dropping. And once it goes below 50, it is a contractionary indicator for the manufacturing segment of our economy. And so obviously this spooked a lot of people. There was some selling from that. Now, a couple points to make is the manufacturing segment of our economy is not the biggest segment. It's a good size, but It's definitely not as much as the services segment. And so that was more important to see. The next day, the non-manufacturing segment was still in growth, although it did slow down a little bit, which kind of held the market up, but it didn't catapult it back up, of course. But I wanted to show you this 5-year chart because, as you can see, this has happened before. Back in 2016, we had manufacturing numbers get down into this 48 range. And we did bump out of it, so it didn't turn into a recession there. And so, you might make the argument, well, Demo, back in 2016, we were heading into election and Trump got elected. We had the tax reform, regulatory reform, and all these different catalysts. What's going to be the catalyst this time around? Well, what you don't see on this chart, and I didn't put it on the same one because it would have been a little busy, is that interest rates were actually going up, and this is when they began to go up during this exact period. And so the catalyst could be the opposite is going on right now. So right now, instead of having interest rates go up, we're actually having interest rates go down by the Fed to stimulate the economy. The big question is the Fed stimulus going to be enough? I tend to lean on that it will be, but I am also a little cautious about that because it hasn't worked 100% of the time. But that is something that at least gives me a little glimmer of hope. Another optimistic data point that came out recently was the FICO scores. The score that tells you if you have good credit or not. Well, what you see here is the FICO scores since the Great Recession back in 08 here. Sorry, here we go. Have been going up steadily over the last 10, 11 years. And in fact, we are at the highest point that we've ever been. And so my point of showing you this is, again, the consumer is the key. We have healthy consumers that are employed. Their wages have been going up. It's been slow, but it has been going up. They're feeling pretty good, and their FICO scores are good, meaning that they could borrow money and they don't have excess amounts of debt. And so this is a good sign for our economy, based that our economy is mostly on consumer spending. So an optimistic data point that a lot of times gets overblown, or I should say overlooked by the media. Okay, Demo, you showed me a lot of great things, but what's the bottom line here? What's your outlook? Well, first of all, the Fed has been cutting rates. They cut rates again in September, and the market is pricing in at least one more cut for the year. So again, it's going to be another stimulus for the economy. And the Fed is not the only one doing this. We're seeing this really across the globe, especially in China. Since they have been hurting, they are looking at a lot of stimulus as well. So number 2 goes along with that. Global growth is soft, but it may be bottoming, and I think a lot of that has to do with the Fed. Now, there is some limitations on what the Fed and the central banks can do, especially in Europe, but China may have a little bit more room for that. And number 3, the trade war, Brexit, they continue to be a headwind, but I think there's going to be some clarity coming. We're seeing Brexit, some deadlines hit. We're seeing China come, meeting with the United States. So hopefully there's going to be some resolution. The elections are getting closer, and so I think the closer these elections get, the more willing Trump might be to making a deal and making some concessions with the Chinese. So we'll see. I'm staying optimistic on that. So the bottom line is we're going to continue on the same path. What I've been calling the middle lane, not going too aggressive, not going too conservative, because there's such a polarized market outcome that can happen because of all these tariffs. And if you could tell me what's going to happen there, I'll hire you on the spot. It's a very confusing and difficult read on what's going to happen there. So I hope you enjoyed this, and stay tuned for one last slide. So at the beginning of this presentation, you saw the agenda slide. It said patience is a virtue. This is my slide here to show you what that's all about. On the 5-year, if you have a 5-year holding period, this is going way back into the mid-30s until the end of last year. if you would hold stocks for a 5-year holding period, stocks were up 90% of the time. So that's 70 up periods and 8 down periods. So the message here is have a little patience. Remember that you're not investing for 1 year or even 2 years. Most of you, and I know that you're investing for more than 5 years even, but when you look at longer time frames, the volatility becomes a little bit more of a blur. So I would encourage you to keep that in mind and have a little patience. Before I let you go, one last thing is the Fiduciary Standard. I thought about that this week. I was doing a devotion and I stumbled upon this verse, and it made me think of the Fiduciary Standard, which is again where a registered investment advisor acts in your best interest. So the verse reads like this: "Do nothing out of selfish ambition or vain conceit. Rather, in humility, value others above yourselves, not looking to your own interests, but to each of you the interest of the others." And there's a lot of neat things that we get from the Bible. I think the Fiduciary Standard may have started there. And this is not just about investment advisors, okay? My challenge to you is that this is really about anybody you meet, friends, family, but even strangers. And I would just challenge you to treat people, and with their best interest in mind in all things that you do. And I think you'll see some pretty amazing things happen. So thanks again, everybody. Until we meet again.